What if I told you the money in your pocket isn't really money? That every currency on earth, every dollar, rupee, euro, yuan, is nothing more than someone else's debt? And here's the question almost nobody asks. If money is debt, who does the world actually owe? Tonight, we're going to pull apart a system so ordinary you've lived inside it your entire life, yet so engineered, so perfectly constructed, that it has quietly turned every nation, every business, and every person into the product of a financial machine designed for one purpose: perpetual dependence. Because there was a moment, a precise moment, when money stopped being something real and became debt instead. This is the story of how it happened, why it happened, and what it means for the future you're about to inherit. To understand how money became debt, we have to go back to a world before banks, before digital payments, before inflation charts, back to a time when money was nothing more than a metal coin with value baked into its weight. For thousands of years, gold and silver served one purpose. They were final. When you paid someone in gold, the transaction ended. No counterparty risk, no signatures, no banking system required. But societies grow, empires scale, wars happen, governments overspend, and eventually, every great power in history faces the same problem. Real money limits what rulers can do. They can't print gold. They can't create silver out of nothing. They need something far more flexible, something elastic, something they can control. And that is where the story takes its first twist. Because as economies expanded, kings, emperors, and later governments found a loophole so powerful it would flip global finance upside down: the creation of money that represents value instead of containing value. This idea seemed harmless at first, but it would evolve slowly, carefully into the foundation of the modern financial system, a system where money and debt merge so tightly that you can no longer tell where one ends and the other begins. Money becoming debt didn't happen in one day. It was a multi-step transformation over centuries, each step justified by a crisis. Let's break it down. Step 1. Deposits become promises. In medieval Europe, goldsmiths stored people's gold for a fee. They realized something shocking. Most depositors never came back for their gold at the same time. So the goldsmiths began lending out more receipts than the gold they held. They had created the first form of fractional reserve banking. A deposit, something real, became a promise, something abstract, and money took its first step toward becoming debt. Step 2. Governments take over the game. As banking spread, governments saw an opportunity. Instead of letting private goldsmiths issue promises, states created official banks and formalized the process. Receipts became banknotes. Banknotes became currency. Currency became symbolic. But here's the twist. Each piece of currency was still technically redeemable for gold. There was still an anchor, a safety valve, until nations realized they didn't actually want that safety valve, because the anchor represented limits, and limits stand in the way of expansion. Step 3. War forces a break with reality. Every major war is financed by debt. And during conflict, leaders suspend gold redemption. Temporarily, temporary in the same way that some taxes were temporary 100 years ago. When countries needed money fast, they printed it. When the printed money outpaced their gold reserves, they quietly redefined what money meant. The promise that debt became the real thing. And eventually, gold backing became nostalgic rather than functional. For centuries, money drifted toward abstraction. But there was a single, historic breaking point, a moment that locked the transformation in place forever. August 15, 1971, President Richard Nixon ended the convertibility of the US dollar into gold. With that single announcement, the global financial system lost its anchor. Money was no longer backed by anything, not gold, not silver, not commodities. Its value came only from government decree, public belief, and the financial system's willingness to treat it as currency. That was the day money became a claim on future production, a promise of repayment, a liability on someone else's balance sheet. In simple terms, money officially became debt, and debt became the world's true currency. From that moment forward, the world economy entered a new phase, one defined by limitless credit, expanding balance sheets, and a global addiction to borrowing. When something becomes unlimited, it becomes essential. Once money was unshackled from gold, debt exploded. Governments realized they could borrow endlessly without the public noticing because inflation spreads the cost invisibly across the population. Corporations realized they could leverage themselves to grow faster than competitors. Consumers were encouraged through advertising, policy, and culture to live today and pay tomorrow. The system didn't just allow debt, it required debt. Because here's the dark truth nobody likes to explain. In a fiat system, without new debt, the money supply shrinks. And when the money supply shrinks, the system collapses, so governments must borrow, banks must lend, businesses must expand credit, consumers must take loans. In this new reality, debt isn't an exception, it's the fuel, but fuel has limits, and eventually, the world raced toward a breaking point. The consequences of a debt-based system aren't theoretical, they are visible, measurable, undeniable. Every major economic crisis in the last 50 years has been rooted in debt. The Latin American debt crisis, Japan's asset bubble collapse, the 1997 Asian financial crisis, the dot-com crash, the 2008 global financial meltdown, the European sovereign debt crisis, modern inflation waves linked to unprecedented stimulus injections, different regions, different triggers, but always the same underlying weakness, too much borrowed money backed by too little real value. The system creates growth, but at the cost of fragility. Because when money is debt, and debt grows faster than the economy itself, you get imbalances that nothing can fix. Not interest rate cuts, not stimulus checks, not austerity, not quantitative easing. Every solution is just a new version of the same problem. To solve debt crises, we add more debt. It's like using fire to put out smaller fires. It works until it doesn't. Over the decades, governments and central banks have tried to fix debt problems, but each fix has only deepened the dependence. Lower interest rates, cheap borrowing stimulates growth, but when used again and again, it destroys savings and pushes households into more debt. Quantitative easing key, inject money.com markets, stabilize banks. But this expands the money supply faster than productive value, creating bubbles everywhere. Debt restructuring, extend the loan, change the terms, pretend the problem is solved. But all this does is push today's crisis into tomorrow. Financial innovation, derivatives, securitization, leveraged products, all designed to spread risk. Instead, they spread fragility. Each fix treats the symptoms. None addresses the root issue. Money and debt are now the same thing. You cannot reduce one without shrinking the other. And that is why every modern economic fix quietly deepens the dependency. If you think this is old history, look at the numbers today. They reveal a truth so shocking it's almost surreal. Global debt is now over $300 trillion. That's over 3 times global GDP. For every dollar created, more than $1 of debt exists. No major economy can repay its national debt without collapse. This isn't a glitch. It's how the system is designed. Because if debt is the currency, and the currency is debt, repayment becomes mathematically impossible. To repay would mean deleting money from the system and starving the global economy. So instead, the system requires more borrowing, more expansion, more dependence. It's a loop, a cycle, a treadmill with no off switch, and you are living inside it. History shows a repeating sequence. 1. Money becomes symbolic. 2. Debt grows faster than production. 3. Governments intervene with new financial tools. 4. The tools work temporarily. 5. The debt grows even faster. 6. The system becomes too big to fail. 7. A crisis forces a reset. That reset can be inflation, currency, devaluation, debt monetization, or a shift to a new monetary system. But something always changes. Because no nation in history, not Rome, not Britain, not modern superpowers, has survived a debt-based monetary system indefinitely. The question isn't if it ends. The question is how. Money is no longer wealth. It is a claim on future wealth. What you call money is actually an IOU issued by an institution that expects the future to pay for the present. Debt is the engine, not the outlier. Governments, corporations, and individuals must borrow not because it's smart, but because the system collapses if they don't. The next financial reset is inevitable. Not catastrophic by default, but unavoidable. Every debt-based currency in history eventually restructures, reforms, or replaces itself. The transition is always fastest right before it becomes visible, and when a system built on promises starts to lose trust, the shift happens in weeks, not decades. So the real question is not whether the world changes, but whether you understand the rules before the next chapter begins. If you found this breakdown valuable, hit subscribe, turn on notifications, and share this video with someone who still thinks money works the way school textbooks describe it. Because the more you learn about how the system actually functions, the less control it has over you.